So, millions of baby boomers are struggling in retirement. Millennials need to save half of their income just to retire in their late 60s. And there's even articles floating around now that suggest you shouldn't be starting to save for retirement until you reach 40. And can I just say how absolutely stupid that is? And every day there are new videos coming from good-looking YouTubers talking about saving and investing. The question remains, when is the right time to start investing? Hello, hello, hello. I'm Andrew and welcome to the Dad Manual. And this is my attempt as a dad and only a dad to talk about when is the right time to start investing. In addition, this is our next round of Financial Friday series, so we're going to cover this week's purchases. So the short answer as to when the right time to invest is the right time is now. We're going to go over in this episode some of the most common discussion points people have that argue that it's not now and we should wait to some arbitrary point in the future. When I talk to people about investing, I often find that the reason they are not investing has to do with the word time. This is interesting because time is at the foundation of investing as a whole. The most common reasons I get are, I'm too young and I don't have the time to invest or to investigate what I should be investing into. I don't have enough money now, and at some point in time in the future, I'll make more money and I can just start investing at that time. I won't live long enough if I start investing now, so why don't I just spend the money now? Because you can't guarantee me that I'm going to live to that time in the future that you're saying that I should invest for. Or, fourth, I should be trying to time the market. It's pretty expensive right now. And I heard from a friend of a friend of a friend of a friend of a friend that, there's going to be a dip or a crash coming, and that's when I should put my money in. I'm just going to wait until that next time comes. So because of that, I thought it was high time we had a discussion about when you should invest. To those of you who say, I'm too young and I don't have the time right now in my life, I point to my 12-year-old daughter. She's been investing for a whole year. What's important about her doing that so early is she's going to be able to compound these gains for the rest of her life. Speaking on compound interest, Albert Einstein said, compound interest is the eighth wonder of the world. He who knows what compound interest is, earns it. He who doesn't understand compound interest, pays it. Time is your most valuable asset in the marketplace. It can allow you to take very small amounts of money and turn it into very large amounts of money. Nobody is suggesting that when you're young that you should be putting in anywhere like $1,000 a month. That'd just be ridiculous. My daughter puts in $2.50 a week. That's what she earns. She earns $5 for her allowance. She puts $2.50 in the stock market. That compounding effect that she's getting right now has already started to multiply that money. When she gets to be my age, she'll be far wealthier than I am now. To those of you who look in the mirror and say to yourself, you don't have enough money right now, and that you're going to wait till some time in the future when you make more money and that's when you're going to start. You need to understand that one of the major keys to investing is consistency. It's doing it over and over and over again. That is what wins the race. It's slow and consistent, not large drops of money getting dumped in at one point in time. Very few people have made it wealthy by doing just individual actions. Instead, it takes long and hard work. One of the reasons I talk about middle class incomes on this channel is because I understand that $25 a week is a lot of money. If you can only do 10 or only do 5 or only do like my daughter and do $2.50 a week, that's okay. Nobody's asking you to do more than save one cup of coffee from Starbucks every single week, set it aside, and put it into a fund. The next thing that I often hear is that people say, I don't know if I'm going to live long enough to reap the rewards, so why should I even start to begin with? You can't guarantee me that I won't just die tomorrow. My time could be up. Well, you know what? You're 100% correct. That could happen. Statistically, though, if you're 50 years old, you have about an 80% chance of living for another 20 years. And healthcare only gets more expensive as you get older. That number jumps up if you're 40 years old. To live another 20 years, to get to 60, you've got over a 90% chance. 20 years toward the end of your life, that's when things start to get expensive. When we go down to 30, if you're 30 years old and you have kids, in 20 years, college is super expensive. Look at this. You have a chance of 95% chance of making it 20 years at the age of 30. And if you're going all the way down to being 20 years old, well, you know what? You're at 97.5% chance of success of living until 40. Just going ahead and starting. And I'm telling you, when you get to the end, things get expensive. Doctor bills get expensive. Your time runs out and you don't have anything to pass on to future generations, to your kids, to your loved ones. That's when it's over. This is the absolute worst reason to not be investing. If you go back in time to any crash and you fast forward from that point 20 years in the future, you will find you will have been better off investing every single time. If we go ahead and take a look at, say, Amazon, at the dot-com bubble, when we went all the way from the height of the dot-com bubble and things were so overvalued that the PE ratios were in the tens of thousands, and we take the peak of the dot-com bubble and we compare it to what our rate of return would be now, we would have been up 3,000% 20 years later. 3,000. That's a 30x on your money if you invested on the absolute possible worst day to have ever invested right before the dot-com bubble. Fast forward 20 years and you'd have gotten a 30x on your money. If you go and you start looking at something like Microsoft, if you think this is just Amazon's just one company, well, back then Microsoft was a big company, it was a stable company, and even if we went back to Microsoft and we said, you know what, let's go back to the peak of the dot-com bubble and see what it is now. What was life like? Well, guess what? You would have made 350% on your money. 350%. Your money would have tripled over that time. It would have tripled. This idea, even if you'd have gone, let's just say you wanted to bet on the U.S. economy instead. Just the U.S. economy. You're not going to go ahead and you're not going to individually pick a stock. You know what? Because you're just not confident of that. That's fine. We're not going to go to Coca-Cola. That's fine. We're going to go ahead instead and we're going to say the S&P 500. If you picked it at its height before the crash, you still would have been 153% better. You would have given $1 and you would have gotten back $2.50. There is never a time where you should be playing the dip. Ever. I'm not saying you don't keep any money back for when prices drop. That's a completely different strategy. Trying to argue that you shouldn't start until you get the next crash, that's just stupid. All right? That is absolutely stupid. Here, let me give you an example. I just had a conversation with somebody close to me where I was trying to explain to them the reason that they should be diversifying and getting some money into growth stocks. This person, for context, is already a real estate investor. So they already put their money in one style of investment, real estate. They get good cash flow out of it and everything works fine. We talked a little bit about whether or not it's smart to put money into the stock market now because he's worried that, he's just going to lose money. If he loses money, he doesn't like to see the red on a day. And I'm trying to explain to him, it's not what happens today, it's what you're doing for the future. So we took an example and we said, hey, back when you first started investing into real estate, around what time did you invest? And the person told me, I invested about July of 2003. That was when I first made my investment. And I said, well, when you invested in July of 2003, let's just say that instead of investing in the housing market and you bought a single family house, let's just say instead you bought, maybe Apple stock. All right. July 2003, Apple stock would have traded at, July 11th, it traded at 35 cents a share split adjusted. 35 cents a share split adjusted is what we'd be talking about. So we're going to assume the amount of money that you put in to the house that you bought, your very first house, instead you just put that amount of money into Apple stock, where would you have ended up at? Where? So what I showed this person is if they had put that $27,000 into Apple, they would have purchased it at 35 cents a share. Now they could have purchased 77,000 shares, but we rounded it down to 75,000 for easy math. The current price when we looked at this recently was $120.99. That would have put the value today, in today's terms, at $9 million. With a dividend yield of 0.68%, that would be yearly cash flow of $61,000 or $5,000 every single month. I looked at this person and I asked him, does your single family house produce you $5,000 of monthly cash flow every single month? They looked at me and said, no, it doesn't. I said, well, you shouldn't be worried about timing the stock market then. You should be picking stocks just like you pick houses that you believe in, that are going to be good long-term investments. Because that's what matters when we're playing this game. Time in the market, compound growth, does so many wonderful things. So I hope by now I've convinced you that the time to invest is today. It's not to wait until you get older. It's not to wait till you have more money. It's not to wait until the next market crash comes. And it's certainly not to wait because you don't know that you're going to live long enough to reap the rewards. I'm not suggesting you put every single dollar into the market at any point in time and that you go all in. I'm just telling you, time is of the essence and you don't have the time to not be investing. So that brings us into this week's investments. So you can see we made our order in Dropbox this week. We were able to take advantage of some of the dip. So at this point in time, we totally as a whole own 4.273 shares because of that dip. And we're down only 2%. The thing is we should not be looking at what it's going to be like now and that short-term up and down fluctuation. This is just a sale. We need to be focused on what it's going to look like in the future. So you can see we put another $25 into Verizon. We were able to pick that up as a discount as well. Overall, we're up a little bit on Verizon. No big deal. We're looking toward the future here, and I'm excited to show you how dividends play into this in the future. So you can see how reinvesting dividends can actually lead to more compounded growth. As far as our growth account goes, my favorite stock, Tesla, we bought it on a huge dip. That drives down our cost basis. We got it at $6.69. So, I mean, that's a big freaking deal to me. Our position right now is still really low, and it's still down 10% overall. But I'm telling you, this is a steal. In the future, Tesla is a multi-trillion-dollar company. The fact that it's this cheap right now, we should be taking advantage of this dip. And this is showing you, from my own experience, that yes, even in an account this size, I would still take advantage of this dip. And as far as our S&P 500 index goes, yep, we put in $25 more there. Right now we're sitting at just about the same amount of money that we put in. We're down $1, so we're down minus 0.69% as a whole. This is probably going to be, again, our old faithful. It's not going to go up by a whole ton. It's not going to go down by a whole ton. But if you looked over a period of 20 years, every dollar you put in this should give you back at least $2.50 in return. That's the way the S&P 500 works. It's like betting on the overall economy. Well, that about wraps up today's episode. What I want to know, though, is when you think the right time to start investing is. Tell me about it down in the comments below. And thanks for joining me today. If you haven't done so already, please give me a thumbs up, hit that subscribe button, and share this with one of your friends. It really does help out the YouTube algorithm. Here at the Dad Manual, we're changing our release schedule, and next week we're moving to every Tuesday and Friday. That's going to be the main videos that we're going to release are going to be every Tuesday and Friday. We're doing that because we're going to start experimenting here with something called YouTube Shorts, which are short videos between 15 seconds and 50 seconds, and we're going to post those on Monday, Wednesday, and Thursday. They're going to be short, brief explanation videos. So that way you don't necessarily have to come for an entire 8 to 10 minute video. You can see a small clip instead and get your questions answered. Until next time, I'm Andrew Sherman, and this is the Dad Manual. And remember, failure isn't bad. Failure to try and learn is. Have a good one.